So recently the SPY has been on a monster run. In fact, we've gapped up the last 4 days, I believe. Over and over and over again, the SPY has been fairly bullish as we sit at a new all-time high. And I'm actually going to highlight why I think the market will go even higher. But it's not without a few caveats. So first things first, we're sitting right now at 688.35 on the stock market. It's pretty high. We're right just shy of the new all-time highs we made today, intraday. And I think we're going to go much, much higher. Now, if you've watched the channel in the past, you saw that I made a prediction that we'd see 700 before the end of the year. And obviously, we're not there yet, but we do have 2 more months to get there. And I still think we're on track to hit that 700 price target. However, I am looking at even higher, 750 to 770 by the end of probably between Q1 to Q2, somewhere in that neighborhood, which is another 10% or so. And that's a conservative estimate because I do think we might go even a little bit higher. Here's why. Yes, the market's at its highs, and I see a lot of people on social media in general talking about breadth, right? And what is breadth? Well, breadth lets you know how all the other names in the stock market are performing in general, how what makes up the entire stock market is performing versus the weight of each individual stock. So for example, a stock like NVDA affects the market. It's either 8, 9, 10%, something like that, just that stock alone. So when NVIDIA moves up, theoretically, let's keep it simple math. Let's say it's 10% of the SPY, right? If NVIDIA moved up 10%, the SPY would move up 1% on its own just because of NVIDIA doing its own thing. So as a result, when we have breadth, when we look at breadth, that is a strong outlier in comparison to everything else that makes up the 500 names in the SPY. Because you got to remember, the SPY is comprised of the 500 strongest holdings in the stock market, mainly why the reason it goes up and to the right consistently. And part of the reason why I think it's going to go up and to the right some more is because of how much all the other names are actually lagging. So what I want to highlight to you guys right now is the RSP. And if you don't know what the RSP is, this is the equal weight S&P 500. Now, they might look very similar, and obviously I chart SPY quite a lot more, and so they might look a little similar, but there is a few key differences here. Obviously, what makes it up is that it's the equal weight, right? So it's how much, if you took all the names in the SPY and you equated them to equal value of terms of weight, so that in the first example where NVIDIA weighs 10% of SPY, in this case it weighs the same, whatever, 1/500th weight as all the other names, what the performance would look like. And when you do that and you compare the last 6 months, you have roughly, as you can see here on my chart, about a 15% gain on RSP. Pretty good, right? Now, if we go to the regular SPY, and got to excuse all my lines here, going to make it as clean as I can here, 27%, almost double the move of RSP. So the SPY has almost moved double than equal weight SPY has moved, meaning the outliers in SPY are doing a lot of the heavy lifting right now. Consequently, that opens up the door to a few potential interesting thought processes. Now, obviously, someone of a more pessimistic viewpoint may say, well, that's a lot of weight focused in one place. What happens if those things get bearish, they see a drawback, etc.? Obviously, the market's going to react negatively, and obviously things would come down a bit. But I would like to lean on more of the optimistic point of view, where even if those segments of stocks where you're talking about your Mag 7 names may see a moment of bearishness, maybe it doesn't necessarily stick around for long, or maybe it's a short-term correction, whatever, which is perfectly healthy and normal. I would like to look on the optimistic side of things, like I previously alluded to, and see where the opportunity longer term may be. And that's where the whole breadth conversation comes into play. Whereas the RSP has moved up and to the right, just like the SPY has, is done so at a smaller degree. Another part of my analysis here that I want to highlight to you guys is the IWM. So the IWM is the Russell 2000. This is what I personally use as kind of like a sentiment driver for the stock market. It's your small, your medium cap names, and the stocks that are highly affected by, obviously, interest rates. These are companies that may or may not make money. And they are smaller. So this is kind of giving you the idea of the lifeblood of the American economy, as I like to think of it. And I don't mean that in the sense of like the people who employ the most people, but I mean that in terms of the next big thing coming up through the ranks to eventually graduate into the S&P 500 one day. And this kind of gives me an inkling on how those smaller companies are performing. And obviously, since that little tariff drop here, they've been performing pretty well. In fact, if we zoom out here on the monthly, and hide my lines here for a moment, we're sitting at all-time highs as well on the IWM, which is pretty solid. In fact, I think IWM is set out for a stronger rally in 2026 than the SPY is, believe it or not. But this video is about the SPY. That'll be a video for another day. But I do want to highlight the strength of IWM and how much it has been pushing, basically moving in the same direction as the overall market as a whole, which gives me good sentiment that things are looking positive. Now, the one thing that a lot of people aren't looking at the end of the day is fundamentals. And you might say, well, I look at fundamentals all the time. You might, but me, I'm a technical trader. A lot of other people are technical traders. Maybe we're not considering the fundamentals. Maybe we're not looking at how NVIDIA's fundamentals look, how Google's fundamentals look, how Apple's fundamentals look, because we're ignoring that for the growth prospect, of course. But if we look at the fundamentals of, again, the breadth, right, all the other, 493 names that make up the SPY, how are they actually performing? So I took a deeper dive into that, and I was thinking to myself, how, as a whole, how are these names are performing from a fundamental basis? So ignoring the charts, how are the other 493 names that make up the SPY actually looking to perform and continue to perform? And so far, in general, the companies that make up the S&P 500 have been killing it on earnings. So currently, for this current reporting quarter, 82% have beat. So out of all of the ones, so if we comprise them into a 100% sector, where if we hit 100%, that means everyone beats. If we hit 0, nobody beat their earnings. 82% have beat their earnings as it stands right now. And especially with this specific week, and if you're watching this later on, time. But this specific week, we have got 30% of the SPY reporting this week. So we'll get more data as we come. But as of this morning, about 82% have beat their earnings. And it's looking like, based on an estimate, that 85% of the S&P names will actually beat on their earnings. So that may not mean anything to you. What that does mean to me is that a lot of companies are beating their earnings, which is good. And you would logically think from a point of view that, hey, if I'm a CEO and I'm saying I anticipate to make this much money, or we guide it this much, like we're going to say we're going to make this much money, that's where our guidance is, you probably want to hit those targets, and more than likely you do. So how frequently do we hit these targets, right? The historical average of companies that hit their earnings or succeed them, beat them, is 74%. So right now, as it stands right now, we're at 82%, or an 8% significance to the upside that more companies are actually overachieving on the goals they set for their earnings. And if we round that up to the 85 that's kind of anticipated, that will be an 11% gain over the historical average, which would mean it would be the highest historical average of S&P companies beating their earnings since Q2 of 2021. That's back in the COVID times. So now put that in a big ball of understanding, right? We're comparing companies right now that are on track to have the best performance in general, beating their earnings in comparison to COVID time, where companies were, they were lowballing their earnings. They're saying we don't know what's going to happen, so we're going to guide down a little bit. We're going to suggest we're going to be a little bit lower and be a little bit more defensive with our assumptions, and they beat very well. Things went better than expected. But we don't have that catalyst right now. Yes, we have tariffs and whatnot, but we don't have end of the world, virus shutting down our business, we can't even make money kind of catalysts. So the fact that these companies are actually reporting and are on trend to report just as well as they did during COVID and significantly above historical averages is what I'm most interested in near term. Meaning, let's assume that when these big tech companies report their earnings, let's assume the most bearish outlook, right? Which is why I'm going to tie this all together. Let's get rid of this big red box here. We're going to tie this all together. No, don't want to do that. Get rid of that. Tie this all together with a very nice little bow. We've gapped up about 4 days in a row on the market, right? It's been moving quite a bit. We have big tech earnings today and tomorrow. Consequently, it wouldn't shock me to fill some of these gaps, or even fill some of these gaps in the near term, meaning maybe next week, right? But I think we offer a very unique opportunity here for the more longer term trader if we continue the trend of these, the 493 companies in the SPY reporting positively and overachieving. Because at the end of the day, when push comes to shove, What the market cares about is fundamentals. If things get bad, right? If tariffs take over the world and growth companies crash or whatever, what really matters at the end of the day is going to be fundamentals. So if we can go back and look at the fundamentals of these companies and see that currently right now they're overachieving with the stock market at all-time highs, a period or any period of significant correction, and even this one was just a 3% or 2% correction, 2.7% correction here on the 10th of October. If we get any period of correction or slowdown for whatever reason, especially if it's off the back of big tech, I will be buying hand over fist, specifically in those 493 companies of the SPY. I'll be looking for the opportunities there, or I'd also be looking for the opportunities in the small caps in IWM, and less so in our mega caps because of how that breadth is. I'd actually be betting on those companies that are not where all the growth is right now, long term, getting some more of that love from the market. Not that I think Microsoft's going to zero or Apple's going to zero, Nvidia's going to zero, that they're overvalued, they have to crash. That's not what I'm trying to say. What I am trying to say is getting some period of correction on those names will offer a unique opportunity to consider other names in the SPY, because they're more than likely going to get some bearishness off of that too, right? The whole market's going to go down. People are going to get scared. They're going to panic sell positions, and you're going to have very good value buying opportunity, in my opinion, when and if that time comes. Now, let's just say that never comes, right? In the market, everything's fine. FOMC goes great. Tech earnings are fantastic. Everything goes up, right? Then let it be. But in the event that it doesn't, and we do have a rational correction here, which I'll take anything between 3 and 5% at this point. A real correction would be 10%. But the market is hot, it's staying hot. If we see that weakness come into those 493 stocks on the stock market in general, and you are a longer term investor, I think you're going to see great opportunity there. Not only there, but those companies will see some downside, but I think the downside would be limited on those companies. So you might see a scenario where those companies, and I'm just talking in generality of the 493, right, come down a little bit, whereas the Mag 7 come down quite a lot in comparison, and obviously the SPY goes down. So there'll be an opportunity to purchase the SPY at a discount. There'll be an opportunity to consider something like RSP if you want to. I wouldn't look for RSP exposure in this scenario. I'd look for SPY exposure because when things revert to the upside, you now have rocket fuel, because theoretically those 497 companies did not discount as much, but they've already been at a discount in comparison to their earnings. Again, speaking generalities. And when those overpriced companies, those big tech names that are overpriced, come down a little bit, you're now at a rare point in time where everything is at a discount, right? Very similar to tariff time, which is driven by a news catalyst, a little different. But what happens when we see a steep discount across the board like that, you will get a hard rally. And that is why I think we will see, and I'll say it, 770 on the SPY in between, so I should say before Q2 next year, 2026.